When people talk about what a company's worth, it feels like we often use these terms like equity value, enterprise value,
Hmm.
and they get tossed around, but maybe they don't tell the full story. It can be surprisingly complex under the hood.
It really can.
So, welcome to the deep dive. We take the finance material you send us and, well, we pull out the really crucial bits. Today, we're focusing right in on equity value and enterprise value.
Good topic.
Yeah, the idea is to, cut through some of that confusion, give you those aha moments without just overwhelming you with data. We want to get clear on what they actually mean, how you calculate them, why they matter.
And we're drawing from that guide you shared, which looks like a pretty solid overview of metrics and multiples.
Exactly. And we've got our expert here to help us synthesize it all and give us that wider context.
Happy to dig in. It's fascinating, really, how both equity value and enterprise value are trying to answer that same basic question.
Mm,
What's this company actually worth? And the guide sort of hints at this fundamental idea in valuation, that a company's value is tied to its future cash flows,
mm.
right? Discounted back to today.
The present value thing.
Exactly. Now, there are complex ways to do that math, but the core idea is cash generation potential. Equity value and an enterprise value are just, well, different ways of looking at that overall company value.
Okay, so let's unpack that complexity you mentioned. The guide touches on it. Why isn't company value just one simple number? Why the two main approaches?
Well, there are a couple of reasons. First, how you see the value can really depend on who you are. Are you an equity holder
Mm,
looking at your potential upside? Or are you, say, a lender more worried about getting your money back? Different perspectives.
okay.
And second, there's this difference between market value, or what the stock market says right now, or what current owners want,
Yeah.
and what we might call intrinsic value, which is, what the company should be worth based on its fundamentals, its future prospects.
Right. And the guide uses that example about growth expectations, doesn't it? To show how those two values can diverge.
Precisely. Like if you think a company is going to grow cash flow at, say, 4% a year, you get one value in your model.
Yeah.
But maybe the market or the current owners, they're banking on 5% growth.
Yeah.
Well, their asking price, the market value, is probably going to be higher.
I see.
And honestly, most disagreements in valuation, they often boil down to different assumptions about that future growth rate.
That makes sense. So that really sets the stage for why we have these two main metrics, equity value and enterprise value, looking at it from different angles. Let's start with equity value. What's the core idea there?
Okay, equity value. The guide lays it out pretty clearly.
Yeah.
It's the value of everything the company has. Think net assets, so total assets minus total liability.
Okay.
But, and this is key, it's the value to the equity investors, the common shareholders.
Just the shareholders.
Just the shareholders. You often hear called market cap, right? Market capitalization.
Yeah, all the time.
And for public companies, the calculation is super simple. Current share price times the number of shares outstanding. Boom. Done.
Which is probably why it gets reported so much in the news. It's easy to find.
Exactly. It's readily available, quick snapshot.
Okay, so that's equity value. How is enterprise value different then?
Enterprise value takes a broader perspective. It focuses on the value of the company's core business operations.
The engine room? Sort of.
Yeah, exactly. What the guide calls net operating assets, or NOA. So the assets directly used to run the business, minus the liabilities generated by those operations.
Okay.
But this time, it's the value available to all investors. Equity holders, yes, but also debt holders, preferred stockholders, maybe others who've put capital into the business.
So it's the whole pie's core ingredients, not just the slice for equity holders. The guide mentioned Target as an example. Maybe you can paint a picture for us.
Yeah, think about it like this. Equity value is what's left for the owners after everything else is paid off, all assets minus all liabilities. Enterprise value zooms in on the value of the actual business itself. It tries to ignore things like extra cash sitting around that's not needed for operations.
Mm-hmm.
And it includes the value of the financing, like debt,
Mm-hmm.
that was used to build that core operating business. So it's focused on the operational value generator.
Got it. And here's something that the guide really emphasized, which I found interesting. Enterprise value tends to be more stable. Why is that?
Ah, yes, that's a crucial point. Enterprise value often stays relatively consistent, even if a company changes its capital structure,
Yeah.
swaps some debt for equity or vice versa.
Okay.
Equity value, on the other hand, can jump around quite a bit just because of those financing shifts. The guide had that example, right? Same core business, 3 different ways of funding it.
Yeah, I remember that.
The equity value changed in each case, but the enterprise value stayed pretty much the same.
So if you're comparing like two companies in the same industry, but one has way more debt?
Exactly. Using enterprise value gives you a cleaner comparison of their underlying operations. It strips away some of that noise from how they chose to finance themselves. That's a big reason analysts often prefer it for comparing companies.
That makes a lot of sense. Okay, the guide also talked about why we pair enterprise value with net operating assets and equity value with just plain net assets. What's the logic connecting those pairs?
Well, the thinking generally goes like this. Equity capital, whether it's retained earnings or new shares, can basically be used for anything, right? Core operations, side projects, whatever.
Okay.
But when a company goes out to raise external capital, like debt or preferred stock, it's usually argued that money is intended to support the main business, the core operating assets.
Lenders want to fund the reliable part.
Sort of, yeah. They're less likely to lend you millions to, speculate on something totally unrelated. So enterprise value, which includes that debt and preferred, is linked more closely to the operating assets those funds likely support.
Whereas equity funds the whole shebang.
Pretty much, yeah. Equity value reflects the value of all net assets, operating or not. Now, the guide rightly points out, reality isn't always that clean cut. Companies do sometimes borrow for non-core stuff,
Sure.
but it's the general principle linking the scope of the value metric,
Yeah.
all investors versus just equity, to the scope of the assets, operating versus total.
Okay, concepts are clicking into place. Now let's talk calculation. How do we actually find the current equity value?
Right, the guide lists three main ways. For public companies, number one is the one we mentioned, shares outstanding times the current share price. Easiest way.
Okay.
Method two, less common maybe for live calculation, but conceptually important. Market value of total assets minus the market value of total liabilities, except for common equity.
What belongs to everyone else?
Exactly. And then method three, for private companies,
Hmm.
you usually estimate equity value based on the valuation from their last funding round.
Makes sense since there's no daily stock price.
Precisely.
Okay, so once we have an equity value, how do we get to enterprise value? You mentioned a bridge.
Yes, the bridge. The formula basically goes enterprise value, equity value.
Yeah.
Then you subtract non-operating assets,
Okay.
and you add liability and equity items that represent those other investor groups.
Got it. Can you give us some common examples? What counts as a non-operating asset?
Sure. The big one is usually cash and cash equivalents, specifically excess cash.
Excess cash, okay.
Also things like marketable securities or financial investments, maybe rental properties if they're not a real estate company, side businesses, assets held for sale, discontinued operations.
Things not core to the main business.
Exactly. And sometimes even things like minority equity investments in other companies or the value of net operating losses, NOLs, within deferred tax assets can be treated this way.
And on the other side, the stuff we add back the liabilities and equity for other investors.
That's typically all forms of debt, preferred stock, capital leases are a big one, non-controlling interests.
What are those again?
Non-controlling interests. That's when a company owns, say, 80% of a subsidiary. That other 20% is owned by someone else. Those are the non-controlling interests. Their share of the subsidiary's value gets added back into the parent's enterprise value calculation. Also, unfunded pensions and potentially operating leases, depending on the accounting rules being used.
Okay, let's use that simple example the guide mentioned. Just cash and debt. Walk us through that bridge conceptually.
Right. So you start with your equity value. Let's say you find the company has a lot of cash sitting on its balance sheet, more than it needs for daily operations. You'd subtract that excess cash.
Because it's non-operating.
Correct. Then you look at its debt. You add the value of that debt back.
Because it represents capital from lenders, another investor group.
Exactly. So equity value, non-operating cash plus debt, enterprise value in that simplified world.
And the guide made a point about cash treatment being a simplification, right?
Yes, it did. Look, technically, every business needs some cash to operate day-to-day working capital cash. But for simplicity and comparability across companies, the standard convention in this calculation is often to treat all cash on the balance sheet as non-operating and subtract it.
Even though some of it is operational.
Right. It's a practical adjustment. Very detailed models might try to estimate the true excess cash, but subtracting all of it is common for baseline EV calculations.
Okay. And just to be clear, why add back both debt and preferred stock?
Because both represent claims on the company's value that are senior to common equity. Debt holders and preferred stockholders provided capital, and they have a right to get paid back or receive dividends before common shareholders see anything.
Yeah.
Their capital is part of the total enterprise, so its value gets added back.
Makes sense. What about those other items briefly, capital leases?
Think of capital leases, now often just called finance leases under newer standards, as basically being a form of debt used to finance assets like buildings or equipment.
So treat it like debt.
Essentially, yes, add it back.
And unfunded pensions. That one feels a bit different.
It does, but think of it like this. The company has promised future payments to retirees. If the pension fund doesn't have enough assets right now to cover the estimated present value of all those future promises, that shortfall
Is like a debt the company owes.
it's very much like a debt. It's a claim on the company's future resources. So that unfunded liability gets added back to enterprise value. It represents a claim by employees, sort of like long-term investors.
Okay, that clicks. And operating leases, you mentioned tricky treatment.
Yeah, accounting rules change things. Before, operating leases were mostly off-balance sheet. Now, especially under IFRS, companies record a lease liability and a right-of-use asset for most leases.
So they look more like capital finance leases now?
They do, on the balance sheet.
Yeah.
So under IFRS, you typically add back that lease liability when calculating EV for consistency. Under U.S. GAAP, the treatment might vary a bit more depending on the context and what multiples you're using it with. Consistency is key.
Got it. And quickly, back to private companies. The concepts apply, but the starting point is fuzzier.
Exactly. The ideas of equity value and enterprise value are the same, but you don't have that real-time market price for equity value.
You use the last funding round.
Right, or maybe an offer price if it was recently up for sale. That's your estimated current equity value. So calculating current enterprise value from that is also an estimate, less precise than for public companies. Often, with private firms, the focus shifts more towards calculating implied values using valuation models rather than bridging from a current market cap.
Okay, shifting gears slightly. The guide talked about implications and busted some myths. Let's start with financing events. How do they impact these values?
This is super important. The guide is clear. Financing activities by themselves, like issuing debt, issuing stock, paying dividends, buying back stock, generally do not directly change enterprise value.
Why not? That seems counterintuitive for some of them.
Because they usually involve offsetting changes. Take issuing $100 million in debt. What happens?
The company gets $100 million in cash.
Right. Cash is a non-operating asset. Debt is a financing liability we add back in the EV bridge. So you subtract $100 meters cash, you add $100 meter debt.
Net effect on EV is zero.
Exactly. No change to the net operating assets, no change to enterprise value from that financing transaction alone.
Okay. And equity value. When does that change?
Equity value changes if and only if common shareholders' equity changes on the balance sheet,
So paying a dividend reduces retained earnings.
which reduces common shareholders' equity, so equity value goes down. Issuing new stock increases CSE, so equity value goes up. Repurchasing stock reduces CSE, equity value goes down.
Got it. Now the myths. Myth, #1. Enterprise value is the cost to acquire a company. Why is that wrong?
Yeah, that's a common one, but nope. EV is the theoretical value of the core odds to all investors. An actual takeover price is way more complex.
How so?
Well, you usually have to pay a premium over the current value to get shareholders to sell. There are transaction costs, bankers, lawyers, advisors, big fees. And then there's the question of the target company's existing debt. Does the buyer pay it off, assume it, refinance it? And what about the target's cash? Does the buyer get to keep all of it? All those things affect the final check the acquirer writes, which is almost never just the enterprise value.
Okay, not the sticker price then. Myth, #2. Taking on debt adds to enterprise value. What's the mistake there?
The mistake is thinking that because debt is part of the EV calculation bridge, that adding debt automatically increases EV.
But we just said issuing debt doesn't change EV.
Exactly. Issuing debt increases cash, non-operating assets subtracted, and increases debt, financing item added back. Net zero effect on EV.
Right.
Enterprise value only increases if the value of the core business, the net operating assets, increases.
So if the company uses that debt to build a profitable new factory.
Then EV might increase over time because the core operations are now more valuable. But the act of borrowing itself doesn't magically increase the value of the existing operations.
Okay, that's clear. Let's test this with those quick quiz questions from the guide. Company borrows $100 million. What happens to EV?
Unchanged. Cash goes up, debt goes up, offsets in the calculation. No change to NOA.
Right. What about equity value if the company pays a $50 million dividend?
Equity value goes down by $50 million. That cash comes out of retained earnings, which is part of common shareholders' equity.
And EV.
Stays the same, basically. Cash, non-operating, goes down $50. Equity value goes down $50. They offset in the bridge from EV to equity value. EV equals EQV, non-op assets plus debt.
Okay. Company uses $20 million cash to repurchase stock. Impacts.
Equity value down $20 million. Buying back shares reduces common shareholders' equity.
In EV.
Again, should be unchanged. Cash, non-operating, down $20. Equity value down $20. Offsetting effect in the EV calculation.
Last one. Company sells a non-core side business for $15 million cash. Maybe they make a $5 million pre-tax gain on the sale. How do values change? Assume, say, a 20% tax rate.
Okay, this one's a bit more involved. Selling the asset removes a non-operating asset. They get $15 million cash, another non-operating asset. The gain affects equity.
How?
The $5 million pre-tax gain means a $4 million after-tax gain. 5 meters, 120%. That gain flows through net income to retained earnings, increasing common shareholders' equity.
So equity value goes up.
It goes up by the $4 million after-tax gain. The cash part, 15 meters, just swaps one non-operating asset, side business, for another cash. So that part doesn't directly change equity value itself, though it increases total assets initially.
Sure.
So net increase in equity value is $4 million.
And enterprise value.
This is where it gets interesting. You've essentially converted a non-operating asset, side business, into cash. A&E generated an after-tax profit that boosts equity.
Yeah.
Since EV combines EQV non-op assets plus debt and equity value went up $4, while non-op assets net change is arguably complex, lost asset gain cash, the change of the value of the core business is reflected. A simple way to think. Selling a non-core asset realizes value. That $4 after-tax gain increases the overall pie available to investors. So enterprise value would likely increase by that $4 million after-tax gain, reflecting the value captured from shedding the non-core item.
Wow. Okay, that last one shows how operations do impact things. This has been super clarifying. So boiling it all down, what are the absolute key takeaways for our listener?
I'd say 3 main things. 1, know the difference. Equity value is value to shareholders. Enterprise value is value of the core business to all capital providers.
Okay.
2, understand the bridge. Know how to get from one to the other by adjusting for non-operating assets and other investor claims like debt and preferred stock. And 3, remember that financing changes alone, borrowing money, issuing stock, generally don't change enterprise value directly. EV changes when the underlying business changes value.
Those are great anchors. And understanding this stuff feels absolutely foundational if you want to get into valuation multiples or really analyze a company properly.
Definitely. You can't really understand what, say, an EV/EBITDA multiple means if you don't understand EV.
Sounds like a topic for another deep dive. It really shifts how you might look at financial news or think about what's driving a company's stock price.
Absolutely. And maybe a final thought for you to ponder. Now that you've got a better handle on these definitions, how does all that frantic daily trading in the stock market reflect investors constantly reassessing both the company's overall equity value and the perceived value of its core enterprise? It's this ongoing dynamic assessment playing out in real time, grounded in these fundamental concepts. Something to think about.